On Tuesday, Capital One Financial, or ticker COF, reported second quarter earnings that topped Wall Street expectations, supported by revenue growth and early cost synergies from its Discover acquisition. Adjusted earnings came in at $5.81 per share, which beat the analyst consensus estimate of $4.77 per share. Revenue totaled $15.85 billion, which was ahead of the street estimate at $15.77 billion. Revenue increased 4% from the prior quarter, while adjusted EPS pre-provision earnings were flat as higher operating expenses offset that revenue gain. Management said the quarter captured about 1/3 of the expected quarterly operating expense synergies from the Discover integration and reaffirmed its goal of achieving $2.5 billion in annual Discover-related synergies. Purchase volume rose 26% year over year, primarily reflecting a partial quarter contribution from Discover. Legacy Capital One purchase volume increased 14% from a year earlier, driven by accelerating organic growth ahead of the Brex acquisition and the addition of a corporate card portfolio. Net interest margins expanded 14 basis points from the prior quarter to 8.01%. The increase was driven by lower retail deposit costs, a $5 billion reduction in average cash balances, and an extra day in the quarter. Provision for credit losses fell 27% sequentially, or $1.1 billion to $3 billion. The decline reflected a $3.7 billion in net charge-offs and a $662 million release from credit reserves. Capital One released $662 million from its allowance for credit losses, bringing the balance to about $23 billion. Capital One reported a domestic credit card net charge-off rate of 4.37% in June, and the 30-day plus performing delinquency rate was 3.39 at month's end. Its auto loan portfolio posted a net charge-off rate of 1.65%, while the 30-day plus performing delinquency rate was 4.32% at the end of June. The Common Equity Tier 1 ratio declined 70 basis points from the prior quarter to 13.7%. The decrease reflected a $2.7 billion in share repurchases, the Brex acquisition, and the higher risk-weighted assets. Domestic card revenue increased 30% year over year, largely due to Discover. Excluding Discover, domestic card revenue rose 9.5% on stronger purchase volume and loan growth. Revenue margin was 17.4%, while the domestic card net charge-off rate improved to 4.71%. This is down 39 basis points from the prior quarter and 54 basis points from a year earlier. Domestic card purchase volume climbed 26% year over year. Consumer banking revenue increased 26%, while auto originations rose 19%.